Success for ET Index means helping investors avoid the next financial crash. And I would argue that that will be the carbon bubble. So let me tell you why carbon is ultimately the next big bubble. Climate change poses a problem to the value of investments. And that's really because of three simple numbers. The first, 2 degrees. This is the internationally agreed safe limit beyond which we can go. Now, that means that we have a total carbon budget, the blue bubble right there. Now, if you look at the fossil fuel reserves, which is factored into the valuations of the largest 200 listed oil, gas, and coal companies, that number is 5 times larger. That means that we're going to see a significant write-down in the value of these investments as they become stranded. Now, this isn't an isolated trend. There are now over 60 national and subnational jurisdictions globally that are already putting a price on carbon. For example, in the UK, we have a shadow carbon price now of just under £20 per tonne. This means that over the course of the next 100 years, but even in a much shorter time horizon, given that there's already pressure now, the profitability of high carbon companies is going to suffer in relation to those which are more carbon efficient. Therefore, investors want to understand their exposure to that risk and begin to start reducing it. And that's ultimately where we come in. We do 3 things. We help investors identify their carbon risk, understand their carbon risk, and ultimately reduce it. So the first thing we do is we take the largest companies in the world and we rank them according to their carbon emissions. You can go on etindex.com and see our new live rankings. So essentially what we're doing there is really looking at the full footprint of a company's reported greenhouse gas emissions and letting investors look and see for themselves. We've just released a new tool which is designed to analyze the carbon footprint of a given portfolio. So what you can see here is just a little example where we're taking a well-known benchmark like the MSCI All-World Index and then showing you what would happen if you applied an ET tilt to it, so reduce the exposure to carbon, but whilst either still tracking the market or, depending on your preferences, perhaps you have a greater risk tolerance threshold and so you're not so concerned about closely tracking. The last thing we do is produce a series of low carbon indices. So this is our beta version, which is designed to track the market, and as you can see, it does what it says on the tin, but the crucial difference is that it's reducing your exposure to high carbon companies. So your overall portfolio carbon footprint is significantly reduced. So just talk a little bit about the market. We're seeing really massive growth at the moment, just over 60% in the last year for which there is data. And we're seeing more and more investors start looking at this issue of carbon risk. And we really expect it to be a boom year as we go forward, especially in Paris. We have the climate change negotiations at the end of the year. So just to talk a little bit about the business model, essentially it's a subscription and a licensing one. We license our data. We license the ability for investors to come onto our platform and analyze their portfolio carbon footprint, and then for every additional custom report we produce, that's an additional fee. But really the value and revenue driver for us is licensing our indexes, and we employ the same model that the likes of S&P and FTSE employ, which is an annual license fee and then a basis point commission based on the total size of funds. So to explain a little bit how we differ from the competition. Essentially, nobody else at the moment is taking the largest companies and publicly ranking them. And I think if we're going to start moving our money away from carbon, we need to know which companies are the high carbon ones and which are not in a transparent way. We also crucially include the entire supply chain of a company's emissions, which means that we're actually taking into account the full value chain. And that's often where up to 75% of a company's emissions reside. Our competitors don't do that. So in terms of our go-to-market, our strategy, we've now just released the tool on etindex.com. You can go on there, start to have a look at what different portfolios look like, what the carbon footprints, how they compare to essentially others. And this really is designed for fund managers, asset owners, anyone really working with managing pools of money that might want to understand their exposure to that carbon risk. Some of our clients, we're working with a number of clients who are currently integrating our carbon data into their analysis. We just completed a portfolio carbon footprint for CalSTRS, one of the largest pension funds in the States, and we hope to announce in the next week or so the first seed investor in an ET index fund. Just talk a little bit about the team. I started my career working at Google. For the last 4 years, I've been running the Environmental Investment Organization, an independent research body focused on carbon. Sebastian Hoeg, a colleague of mine, comes from an investment banking background. We've been working together for the last 4 years. Jonathan Harris, he's our quantitative expert, has worked across the financial industry. Farid Tajani, who you might have seen talking yesterday, our CTO, and Kari Grzinski, very respected member of the sustainable finance community. So what are we looking for? We're currently about to open an investment round, looking for around 250,000. And we're really very keen to talk to potential users who might want to assess the carbon risk of their portfolio. So come and talk to me afterwards, or you can go on etindex.com and sign up for free. Thank you very much.